Welcome, everyone. Another great video. We're looking at dividends here. We've talked in the past about could you live off the GIC interest if that was your portfolio? What if your portfolio is all stocks and dividends? Can you live off the dividends? We're going to dive right into that, Kevin. And at first, we have to say that theory, it kind of makes a bit of sense, at least on the superficial level, right? People are thinking, hey, I want my principal intact. I saved up 500,000. I want to maintain that. I want that to go to my next generation. I'm just going to get some dividend stocks. I'm going to live off of those dividends. And there are a few positive points to this type of strategy.
Yeah, there's quite a few differences that go on with this thing. I mean, a lot of people that as you mentioned, want to protect that principal and they want to live off the distributions they can make. So why dividends? Well, dividends can give you a lot of the different things that go on. One of the things that the dividends provide a lot of the times is that liquidity issue. That's a big factor. So drawing out those dividends, whether they're paid on a monthly basis from some companies, most of them are paid on a quarterly basis, but there's that income flow that goes on. And we're talking about stock dividends that are here. So, I mean, the liquidity issue is you can buy and sell stock that's publicly traded anywhere almost, and it's going to be instantaneous to get the capital if you need it. But that liquidity issue, having that cash flow come right to you, that is a big one that dividends do provide from companies.
Yeah, and that's true. Compared to a GIC, you don't have that liquidity. You can't just sell it on a Wednesday and take the cash back. It's locked in. You do have that if you had a stock portfolio with dividends. Another favorable item here, Kevin, is going to be the tax treatment, right? If you have dividends, well, if it's in an RSP, a TFSA, it won't really matter because the tax treatment in those accounts is going to be a little different. RSPs, it's all going to be taxable, doesn't matter. And TFSA, it's all tax-free. It's really the non-registered account because the dividends, you get some favorable tax treatment. If you sell the stock at a gain, you get a capital gain, both of which are treated favorably from a tax preference, right? So you are getting a little bit of a win there from a tax perspective.
Yeah, and that's a big factor to realize that most people don't look at. I mean, if you're getting 5% on the GIC, that's one thing in a non-registered account. But if you're getting 5% on a dividend, I mean, that could be like earning 6 or 7% on an interest equivalent. So theoretically, there's more money in your pocket at the end of the day. So that tax treatment, as you mentioned, in non-registered products can be very, very influential.
Yeah, and we quickly mentioned here, since we're talking tax, it's not all good news. If you have a dividend strategy, let's say you have a TFSA and you really like a U.S. company, pays a good dividend, you pick that U.S. stock. If it's in the TFSA, there could be a bit of withholding tax there. It's not a massive difference, but you just have to keep in mind it's not fully tax-free if you hold it in the TFSA because there could be a little bit of withholding on the U.S. dividend. Just the way the tax works, there's not really an agreement between Canada and the U.S. when it comes to those TFSAs. So you don't get the full tax-free treatment there. One piece we are going to mention, because when we talked about interest in holding a GIC, one of the big barriers was it wouldn't keep up with inflation over the years. If we're talking about this strategy, can I live off my dividends? It's kind of the opposite because typically it's not perfect. You're going to have good years and bad years when you have stocks, but normally it actually keeps up with inflation. And what I just pulled on the screen here, this is from Fidelity. Kevin, there's lots going on, lots of different charts and colors here, but essentially what they're looking at is they're looking at the blue bars, light blue bar, dark blue bar. They're going by decade. Light blue bar is the price return. So the value of the stocks went up. They're looking at the overall S&P 500. Dark blue would be the gain from the dividends. And then the yellow stars where inflation was during that decade. And I'll let you walk through this here, but most often your stocks, your dividends will actually keep up or outpace inflation.
Yeah, so I mean, if you're looking at the yellow dots that are sitting there on that scenario, you'll find that the majority of times the blue bars are either higher than or at least equal to what's gone on. There are a few decades where that doesn't work out. You see the 70s, you see the 2000s, and of course the 2000s for most people would be most relevant, where you had the tech wreck that happened between 2000 and 2002. Then of course the Great Recession in 07 through 09. So that makes sense as to where you're getting it there. But otherwise, as we've seen, inflation has basically been covered by not only the dividend, but the dividend plus the price appreciation. So having this sort of an aspect, having these stocks does give you that advantage at the overall, at the end of the day, you're actually making more and keeping up with inflation, getting real rates of return, as opposed to say a nominal one, which isn't keeping up like you might get in a GIC.
It's a big difference. It's a big difference. And again, what we're talking about here is inflation, the inflation factor. Prices go up over time. And if you had a GIC, you might not keep up with inflation over a number of years, and that could have a big impact. But typically the opposite is the case when you're talking about stocks. That's really the message of the chart here. And we go through scenarios like this and get questions like this all the time, and we welcome those questions. Kevin, how do folks get a hold of us if they have a question?
They go to chatwithclintonandkevin.com. We'd be more than happy to answer any of the questions you have on dividends, the tax treatment they're going to get, also in regard to how they compare to your GICs, and any other financial questions that you can come up with. We'll get back to you as soon as we can. Just send us that, go to the link, make sure the question's there, and we'll respond quickly. But now that we've sort of done the basics on inflation, we've done taxes, it's not all roses at one way or another. There are some things that you have to concern yourself with when getting dividends, is there not?
Absolutely. We're building to this, right? There's always trade-offs. No magic solution. There's always a trade-off. The trade-off here is going to be risk. Dividends are not guaranteed. I know some folks like treat them that way, but I'll pull this up, Kevin. And I think it's going to highlight the point. These are all Canadian companies. This was done by Morningstar. I created the chart. Morningstar had the data there. And it's recent. This is in 2020. And it has highlighted some of the big dividend cuts. Now, if you cut 100% of your dividend, I don't know if that counts as a cut when they remove the whole dividend. But you can see there's some pretty big, ugly red numbers there. So if you own some of these companies, you're counting on the dividend, you completely change your tune after going through these cuts. And this is common when you have economic turmoil. Many companies will adjust their dividends as they're impacted by that turbulence. So the dividends are not guaranteed. You are going to have to accept some risk if you have that type of strategy.
Yeah, and I mean, the big factor to always remember is that the dividends are basically paid out after taxes from these corporations. So, I mean, that's why you're getting a tax advantage down the road, because so if all of a sudden your businesses stop or you're not making as much money anymore, trying to pay that excess out is going to be hard. So there is some risk involved in the fact that, yeah, okay, I've got a good dividend. I've got it in a nice place. If you're earning 8, 10, 12% possibly, just remember that may disappear completely, as we've shown. It's not a rate cut, it's a rate elimination on some of those companies. But as you did see, there are certain industries there that tend to have a little bit more of that volatility than, say, if you're in your financials or something along those lines, which tend to be a little safer. But again, there is no guarantee when it comes to that. So dividends are not guaranteed. So you do have to realize that even though you're collecting them, they may disappear at one day, and then you're going to have to look at something else to try and get that cash flow scenario going forward.
Yeah, and related to risk, I'll pull this up. This is a drawdown chart I created. I'll make it big here so everyone can see. It is simply a Vanguard ETF. It's a Canadian high dividend yield ETF. Not that it's a special ETF, but it is very much a dividend ETF, so it speaks to our point here. It only goes back to 2012, but you can see most folks look at the chart, all right, it goes up and down, but look, it actually finished in a good spot. So if I put my life savings there, I actually ended up with a little extra, plus I collected the dividend. What you could be missing is the ugly red at the bottom. So this would be the principal volatility, the price volatility, and there's multiple times when it went down over 20%. 2022 was an example. 2020 was an example. You got 15, 16 down there, and 10% declines are almost like the norm for this ETF.
Yes.
And a handful of 20% plus declines. On paper, it seems like, hey, it works out. Why would I wait or worry about that? But living through that, if you had your life savings there and you had to see it drop 20%, most folks don't have that iron stomach to see, say, $1 million turn into, say, 780,000 and just say, hey, I'll collect the dividends. It'll work out. Living through it always feels much worse. So this level of risk might not be appropriate.
Yeah, no, I mean, the happiness meter is always that way, right? Those that check their investments every single day are the most unhappy people. Those that say check once every 5 years, they don't realize the 20% drops that they've seen all the time. And that's the hardest part. I mean, monthly statements and things, you always see what's going on. So even though overall in the longer term, things have always worked out well, you do have to be able to live through those 10 to 20% drops that are going to come. It is not that we're just saying, well, it may or may not. They do happen. And they do happen on a regular basis. So you have to be able to live through that if you're going to be able to deal with the dividend distributions that you're going to get.
If this is the strategy, I'm going to pick some stocks, I'm going to collect the dividends, and the stocks will kind of work out over time. Well, you're going to have to deal with that volatility. That's the risk you're accepting. No magic solution. There's always trade-offs, like we're saying. And that's why it brings back to why you need to have a plan. You need to have a goal. What's the purpose of your investment? You're investing just because most people invest because they want to use the money in retirement. They want to use the money to buy a house. They've got a specific goal. So it's more about fit than it is any kind of one-size-fits-all solution. You need to have an idea, what am I trying to achieve? And then have a strategy specific for that. That's the whole purpose of having that plan. And I will say, we talked about dividends here. And in other videos, we've talked about GICs and interest. Can you live off the interest? If you like this video, you're certainly like that one. It's floating on the screen now. Take care, everybody.
Take care.